Hi, I'm Andy, and I'm a qualified accountant and a chartered tax advisor, and in this video I'm going to let you in on some of the top tips that will help you save a surprising amount of money on your loans using simple legal strategies that you can start using today. Laura's kindly put 6 icons to the side of this video, which will act as timers for each section. They should make navigating the video easier for you. And if you're looking for something specific in this video, check out the chapters in the timeline at the bottom. Loans work by calculating the amount of interest you owe on a daily basis, using the outstanding balance at midnight. This means that for every day the loan exists, you pay interest on it. When you make a payment, the money is allocated to the interest first, and then the principal on the loan. On screen is an illustration of how payments on loans are split. This particular loan is a 5-year loan for £25,000 at 10%. The light blue colour shows interest, which shrinks over time, while the navy blue section shows principal, which grows. Remember that your monthly payment remains fixed, but the amount of principal you pay off towards the end of the loan grows. At the start of a loan, most of the money goes on interest, with only a small portion reducing the principal. As you make payments, the principal shrinks, and that reduces the interest charged each month, allowing you to make greater progress in paying off your loan. There's a way to speed this up, but before we get to that, this and all the other videos on my channel are my opinion, not financial advice. It's important that you DYOR, do your own research, and if you're ever unsure, speak with a financial advisor. There are lots of ways to borrow out there, and loans are a way of borrowing which immediately cost money. If you have a good credit rating and want to choose the very cheapest way of borrowing, interest-free credit cards may be a better option. It's possible to make a purchase on a credit card which charges no interest for a defined period, allowing you to borrow for free until that period expires. After that period, you can usually transfer the balance to another 0% card for a small fee of around 5%, which allows you to borrow interest-free for another 30 months. If you already have debts outstanding, you can use a money transfer card to transfer money directly into your bank, again for about a 5% fee. You can then use that money to pay off your existing debts. I'll do a separate video about the beguiling world of credit cards later down the line. Let's get back to loans. PPI, or Payment Protection Insurance, was notoriously missold by UK lenders. It was often included in contracts without a clear explanation, and sadly, it wasn't an isolated case. Similar mis-selling happened with packaged bank accounts and store cards too. Lenders haven't changed, and there are plenty instances of people being missold products other than PPI, and some who, in the middle of the PPI scandal, still missold it. Let's not kid ourselves. Lenders are fundamentally profit-making institutions who lend money to people in need. When agreeing to a loan, look through the contract and make sure that the monthly payment is what you're expecting, and that there are no products other than the loan that you're signing up to by signing your contract. Loan contracts are normally really boring documents, but the areas I always look at when I'm agreeing to one are the interest rate, how payments are allocated, the total amount payable, and how overpayments are allocated. Most personal loans in the UK don't charge early repayment fees where you don't settle the loan in full, unless you pay more than £8,000 and it costs the lender money. This makes partial over repayments attractive because you can save future interest without paying a penalty. This is slightly different if you have another type of loan, like a payday loan or a secured loan, but there will be a contract which will specify exactly how overpayments are handled. It's worth looking through this agreement and giving your lender a call to ask them how it works if you're unsure. Overpaying in the first year saves you the most amount of interest because you avoid paying interest on the additional principal you've overpaid for every year of the remaining term. However, if you overpay later, then you only save interest for the years after making the overpayment. This makes overpayments far more beneficial when made early. I'd caveat this to say that all overpayments are beneficial, just the earlier you make them, the more interest you save. When you make overpayments, lenders will often classify them in one of two ways. They can either shorten your term or lessen your monthly payment. Shortening the term is the most sensible thing to do if you want to save yourself interest, and often this will be the default position that most lenders will take. However, if you have made overpayments and your situation changes, then it could be beneficial to call your lender and ask them to apply the overpayments you have made to date to reduce your monthly payments in the future. This spreads your reduced balance over the original term, lowering your monthly payments. Personally, I've always overpaid when I can. It gives me the option to reduce my monthly payments in case something unexpected happens. This second option is really useful when you have an unexpected rise in expenses or fall in income, and you need some time to consolidate. However, don't use this as a reason to avoid paying off your debts. If you lessen your contractual monthly payment, then you will pay more interest than if you just kept the monthly payments unchanged and paid the loan off early. It's also worth noting that a number of lenders don't allow you to use your overpayments to reduce your future monthly payments, or only allow it when you call them first to discuss it with them, because it's technically a renegotiation of your agreement. The lender is under no obligation to allow you to reduce your monthly payments, even if it's in their favour to allow you to do so. When you want to repay a loan, either because you're refinancing or you have decided to overpay it, you will pay an early repayment charge, or an ERC. This charge is equal to 30 days of interest if you have less than a year left, or 60 days if you have more than 1 year. This interest charge is based upon the size of the loan outstanding at the point you request your settlement figure from the lender. The ERC exists to protect lenders who take a lot of risk by lending a large amount of money to a person who has promised to pay them back. They take this risk because they're hoping to make money off of you from the interest that you will pay on the loan, and when you pay it back early, they receive less money. But I'm not a lender, and there is a way to get around this interest charge. If you are settling your loan in full, you may be tempted to ask for a settlement figure from your loan provider, but this means that they will calculate the full ERC payment due and add it to the figure they present to you. This costs you a couple of months of interest up front, and if you use my example of a 25 grand loan at 10%, a 60-day ERC could cost over £400. Instead, you could overpay most of the loan, leaving a small balance equal to slightly more than a monthly payment. And if you're super cautious, then before you make the payment, you could call your lender and arrange to make the overpayment to spread the remaining loan payments over the remaining term of the loan. After doing this, wait a few weeks and then request a settlement figure. The ERC should only apply to what's left. If I overpay my 25 grand loan down to £1,000, my 60-day ERC should drop from £400 to about £16. If you think I've missed anything, then please leave a comment. I'll probably find them useful or amusing, depending on how cheeky they are. If you've enjoyed this, please make sure you like the video and subscribe to our channel. My most recent video will be on screen now, and I hope to see you next time.